Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. The Australian dollar has resumed to a bearish sentiment after facing the rejection from that key area seen around 67 figure 45. After two posted dojis, the market has succumbed to further bearishness and now looks towards the key support level seen at 65.7080, which coincides closely with the 60-day simple moving average at 65.92. Meanwhile, the US dollar index, which measures the greenback strength against a basket of six major currencies, took a tumble from 106.05 and settled at 105.90 after hitting an intraday low of 105.70. Investors are now turning their attention to the upcoming US inflation data for insights into the US Federal Reserve's interest rate decision. Friday's release of the monthly personal consumption expenditures, or the PCE price index, the Fed's preferred inflation gauge, comes after a slight upward revision in the first quarter gross domestic product, GDP, to 1.4% from 1.3%. The PCE forecast suggests a 0.1% month-over-month gain and a 2.6% increase year-over-year. Positive inflation reading could give further confidence for investors that the US Federal Reserve might start beginning interest rate cuts sooner than later. There is a widespread speculation about a potential rate cut in September, while some reports suggest the possibility of starting as early as July, with another anticipated later in the year, potentially in September or December. In addition to Friday's data, investors are anticipating Thursday night's presidential debate featuring President Joe Biden and former President Donald Trump, which could cause a bit of a rocky ride for some of the markets. Nevertheless, the support, as I mentioned, for the Australian dollar holds around that key level of 65.7080, and if we do see a bounce, which I do anticipate, then looks back towards the top side range of 67 cents. The euro turned back to a weaker stance. The technicals are still supporting some divergence from the RSI and the MACD to the bullish case, and therefore could see a bounce from the key level seen at 106.7075 and look up towards the top side level around 108 as a broader target, with intraday resistance around 107.15 to 107.65.75. All eyes turn to the upcoming French election this weekend, so no doubt there will be much volatility right across the board, and especially for the euro and the pound. Turning to the technicals, we can see that there is, as I mentioned, bullish divergence coming through here from the RSI and MACD, so I do anticipate further upside tests. However, a close under 106.70 would give further indication to a weaker bias and look back towards the levels seen around April, which is around 105.25 to 55. Turning to dollar yen, it still remains fragile in terms of the Japanese yen against the stronger US dollar. As the market breaks into the 161 zone, there are currently no signs of intervention from the BOJ or the Bank of Japan, although traders are monitoring closely for a potential action. Reports state that the authorities from the Japanese Ministry of Finance have suggested that they might delay intervention until after the US personal consumption expenditure report released, as it may contribute further increased volatility across the board. Nevertheless, keep an eye on this pattern here. If we do end up with a gravestone doji, that would increase further downside risk. And let's see if we can see a break somewhere around 160.60, which would lead further to the downside. But overall, with the ADX overheating, an overbought indicator from the RSI does give further concerns for a potential downturn. Turning to the British pound, the market recovered and holds above the key level of 125.65 after taking out the level of 126.40. If we can see a break above 126.65, this would lead further to an upside case and support a move back to 128, but we do need to see the break. Wrapping up with commodities, gold stages another rebound and now looks towards the level around 2,330 to 33. I am a little bit cautious in this current pattern since the engulfing candle was confirmed previously at the break of 2,305. That does open the way back towards a key level of 2,250 to 70, which could see a correction from there back to the top side around 2,350. Nevertheless, the technicals are mixed, so I'm not overly supportive of this bounce. Let's see if the market does give way and look back towards the downside. A bounce in oil as well. We can see now pushing towards the level around $81 to $82 a barrel. As long as we don't break above the level around 82 figure 40, then I still anticipate a move to 79.70, which would confirm the engulfing candle. However, a close above 82.40 would negate the engulfing candle and therefore see further squeeze up towards $85 a barrel. Well, that's a wrap. Thank you for joining me, and as always, look out for the interest rate report, and I hope you enjoy the great start to the new weekend.